people keep saying, how can an economy be in recession if it's creating all these jobs? Well, if you're in a recession where people are forced to take more jobs because the economy is so weak and prices are so high, they can't get by on one job and they need more jobs. And so those additional jobs get reflected in these job numbers. That doesn't show that the economy is strong. A strong economy is an economy where people don't have to work as hard, where you can get by with one job. In fact, you can do more than get by. You can save more.
Peter Schiff is an economist, financial dealer, author, frequent guest on National News, and focuses on weekly economic data analysis and unbiased coverage of financial news, both in the U.S. and global markets. Strong job gains in U.S. add to economic puzzle. Job creation in the U.S. remained robust last month despite rising prices and sharp spike in borrowing costs weighing on the economy. A recession is unlikely to hit the U.S. economy in the next 12 months after Friday's hot jobs report. The latest U.S. payrolls report bolstered the case for high U.S. interest rates for an extended duration and hurt chances of a U.S. rate cut later this year. Gold prices fell 0.5% to $1,938 an ounce, with a session high at $1,950, after losing 1.5% on Friday, the first loss in 4 days and the largest since May 5, resuming losses after a short recovery from two-month lows at $1,932. Gold lost 0.5% last week, the fourth weekly loss in a row and the longest such streak of losses since June 2022 as dollar strengthens.
Initially, gold sold off, the dollar rallied, but then the markets reversed. We had a pretty strong rally in gold, maybe up about 20 bucks, 15, 20 bucks. The dollar sold off. And I thought, maybe the markets are finally moving past this. We got a stronger number and the market shrugged it off. Gold shrugged it off. Maybe, the correction is over. Maybe we flushed out all the week longs. Now gold's going to move up. And I think one of the reasons that gold reacted weaker on Friday than it did on Thursday was, we had a rally already on Thursday. So, gold had rallied. But also, I think the strong movement in the stock market probably got people to lose interest in gold and gold mining stocks when you had such a strong day in the market. There has been developing a bit of a negative correlation, and it's not every day, but I've noticed it, that when the stock market is going down, that's when you start to see some interest in the gold stocks. And so when the stock market is booming, then those stocks are going to have a headwind. And I think that's one of the reasons that you saw weakness. It wasn't even so much that it was the strength of the jobs market, but it was the strength of the stock market that I think was undermining gold, because we didn't see this kind of strength in the stock market on Thursday, and gold was able to rally in the face of a strong jobs report, but it wasn't able to do that on Friday because it also had the headwind of this booming stock market. So at the end of the day, gold was down about 30 bucks. That was pretty much the low of the day. I mean, gold was down and then it fell all day. It never really recovered. It didn't even try to recover. I didn't see any kind of rally at all following the initial drop after we got that jobs report. In fact, it was just a slow and steady grind lower for the rest of the day. Silver also down. Gold below 1950 on the week, 1947, but still, I think holding in a narrow range that to me is bullish. It's consolidating, waiting for the next move up. The dollar did rally, but it sold off the day before, so the 2 days combined were about a push. The dollar index closed the week just above 104, I think at 104.03.
The U.S. economy added just 339,000 new jobs in May, beating estimates of 193,000 handily. However, U.S. unemployment rose to a 7-month high at 3.7% from a 53-year nadir at 3.4% plumbed in April, while averages wage rose 0.3% last month, slowing down from 0.4%. Average hourly earnings, a key inflation indicator, rose 0.3% for the month, which was in line with expectations. On an annual basis, wages increased 4.3%, which was 0.1 percentage point below the estimate. The average work week fell by 0.1 hour to 34.3 hours. The strong jobs number, combined with no signs of incremental wage pressure and a slight increase in the unemployment rate, represented a Goldilocks report for investors because it signaled that despite the solid jobs growth, the Fed could still hit the pause button on further rate hikes at its policy meeting next week.
Why do we keep getting these strong jobs numbers, especially the report we got on Friday, yesterday, from the government? Because this was an even bigger upside surprise than the ADP number. But of course, beneath the surface, it probably has even more problems and inconsistencies that call into question the validity of these numbers. So the expectation for the jobs number for May was 190,000. And the low end of the range was 100,000. And the high end was 265,000. The number came out at 339,000 jobs, way above estimates. And as soon as the number came out, the price of gold tanked, maybe down about 15, 20 bucks initially, right away, just like the initial reaction to the ADP. Dollar went up, the reaction that you would expect, because that's the type of reaction that we had been getting. And in fact, the number was even stronger if you look at the upward revisions to the prior couple of months, because we added about 93 million more jobs because of the, or not 93 million, 93,000, excuse me, additional jobs, not 93,000 jobs were added to the prior couple of months. So it was an even bigger beat. But what was somewhat surprising, given all those jobs being created, is that the unemployment rate rose from 3.5% to 3.7%. Nobody expected that. That was a big jump from the 3.4% from the month before, and above expectations, which were 3.4 to 3.5. So we are in a weak economy, high inflation environment, weak economy, strong inflation, stagflation. That's where we are. Everybody is in denial, but over time, the markets are going to have to accept this reality. Before they do, that's when you have an opportunity to move more money, into the defensive assets, the assets that will do well in an environment where you have inflation, where you have weak economic growth, foreign stocks, commodities, precious metals. I think the opposite, really, of what you saw today, where you had strength in U.S. stocks and weakness in commodities. Although oil prices had a good day and oil stocks did well. It was just the precious metals that were sold off. But I think those are the types of investments that will do well when people get their arms around this reality. Now, also, people are still celebrating, I guess, that the debt ceiling crisis is over. Since my last podcast, when I talked about it before, I did a podcast on Wednesday, and it was that evening that the House of Representatives was voting to pass the Fiscal Responsibility Act, which raised the debt ceiling. Didn't raise the ceiling. It was even less responsible than that. They suspended the ceiling. So the sky's the limit right now for the next couple of years, and they had the nerve to call that fiscal responsibility, even though it was the height of irresponsibility.
If the U.S. central bank continues to raise interest rates, that would lead to higher borrowing costs for households and businesses seeking mortgages or other loans. The expectation is that the economy will cool, easing pressures pushing up prices as higher borrowing costs lead people to cut back on spending and businesses to delay expansions and other activities. This concludes our discussion for today. Do you agree or disagree, and what are the reasons for your stance? We encourage you to share your thoughts in the comment section below. If you found this video informative, please give it a thumbs up. Don't forget to subscribe to our channel to stay informed on the latest news and videos. Thanks for watching.